welcome to the part 3 of the weekly market recap. This is going over the Wednesday trade that we had on EURUSD. We were longs on Thursday, and the lesson of Thursday, the quick little insight to the future of this video is that on Tuesday on Wednesday, not Tuesday. On Wednesday, we did not pay attention to the drawn liquidity. We went against a short-term drawn liquidity, but we're day traders. As a day trader, we trading the 15-minute/5-minute executions. So the daily time frame is literally the most important time frame. The short-term drawn liquidity is the daily time frame. The longer-term drawn liquidity is the weekly. The short-term drawn liquidity will always lead to the longer-term drawn liquidity. So that's lesson, quick little feature insight. But before we do that, let's go to the top-down analysis. But keep in mind, we had our buy strong on this day. And on the higher time frame, longer-term drawn liquidity was bullish. Weekly IRL to ERL, weekly to the upside. On a daily, we had a daily, we had a daily ERL. What I thought was all the way back to premium discounted IRL, but the drawn liquidity got met on the London session. But enough of this, wrong bias right here. I'm gonna talk about the right bias here. So if you go to the lower time frame, the market, content narrative, on the lower time frame, you can see the market on London session already met the drawn liquidity. So we were correct for the first half. So for the first half of the day, we were correct. Our drawn liquidity was overall bullish, was correct. But market hit the drawn liquidity on the London session, so drawn liquidity has automatically changed to a bearish drawn liquidity because market tapped the premium IRL. Now, didn't pay attention to that. I didn't even pay attention to the short drawn liquidity. I'm not gonna lie to you guys. But so that's the cup storm because this is ruthless lesson. Now over here, we go back on the chart. We had a daily premium. We had a discounted ERL to premium IRL right over here. Eventually, from the premium IRL, we're going back to discounted ERL. We had a daily steer to the downside. We had an SMT with a steer to high with the high, but as well had a midweek reversal. Now, our longer-term drawn liquidity was bullish, but our short-term liquidity is bearish. We're trading a 15-minute and 5-minute time frame. Our trades our trades are very short term. It takes a couple of hours to take profit, or sometimes a couple of days. They're very short term. We're trading for short term, not trading long term. So the daily time frame is very important. The short term drawn liquidity is the daily time frame. The longer term drawn liquidity is the weekly time frame. So the daily matters a lot, and that's the lesson we had. If we go to lower time for the market context and narrative, I thought, okay, SMT IRL to ERL. We had that's all we had here. That was for the bullish bias. That's I'm saying that was take a loss here though. So for the bearish bias here, we had a bearish order flow. We're in the premium daily range. We as well had a 4-hour CRT, and if you go to lower time for execution, that's all we had there. Which is literally enough because we had a lot of context. We had a range high SMT as well. By the lower time frame, market, we did have a legit high here, but we did not have the right time to purge. The purge happened between 5 a.m., which we need to purge between 6 a.m. and 10:30 a.m. So the purge didn't have the right time. So I was like, okay, I'm not gonna take a trade. Which, as I said, this is me looking back in the chart. As this Saturday, I'm looking back over the week and taking lesson and journaling over the week. And you can see over here, we didn't take the trade. We took a long. We had a loss here. So the lesson of this trade is I always prioritize the short-term drawn liquidity over the longer-term liquidity because I'm entering on the 15-minute time frame, not the higher time frame. And eventually I wrote down as a rule. I always prioritize the short-term drawn liquidity over the long-term drawn liquidity. The short-term drawn liquidity always leads to the long-term drawn liquidity. As a day trader, the short-term drawn liquidity is my main focus, which is why I constantly prioritize over the long-term drawn liquidity. Ultimately, short-term drawn liquidity paves the way for the long-term drawn liquidity. Short-term drawn liquidity is a daily time frame. long-term general liquidity is a weekly time frame for a day trader. And we are trading the 5-minute, 15-minute time frame, so the daily affects the hourly, the 15-minute, the daily, the 15-minute, 5-minute goes based on a daily candle, and everything is, the system is perfect, by the way. Keep that in mind. The system is perfect. It's perfect, so all makes sense. And we took a long here on Tuesday. We had a long entry here. Our entry was actually wrong as well. This is not our actual entry, but as I said, looking back into the market, our entry is supposed to be on a threshold, but we took our entry just on the Model 1 itself, which went to a loss here. I had a 15.66 pip stop loss. Our actual entry is supposed to be on the threshold. Although it's a loss trade, but we're supposed to have the right entry here as well. The lesson is 2 lessons here. Always prioritize the short-term drawn liquidity over the long-term drawn liquidity. A short-term drawn liquidity will always lead the pave to the long-term drawn liquidity. So I'm a day trader. My main focus on the short-term liquidity because my trades are very short-term. I don't hold my trades for a long term. I hold it for a short term for just a couple hours or a day or so, or a couple of days, which are very short-term. And the second lesson is, cannot FOMO in. I do not have the fear of missing out the setup. I do not FOMO into the market. I will not FOMO in because I had a FOMO problem here. When the body is over in the wick, and the body is kind of thick candle, I enter on a threshold, not the Model 1 itself. Because the body is bigger than the wick, the only time I enter on the Model 1 is the only time I bypass the threshold entry is when the market has an impulsive move, which in this case, the market never did an impulsive move to the upside. So our entry is supposed to be threshold, which although they go in a loss here, but because we had our whole bias wrong, it's supposed to be bearish. In the bearish bias, we never had a setup here. And for the lesson is, even with the loss, we're supposed to enter the threshold. So the lesson is, I always prioritize the short-term liquidity over the long-term general liquidity. Because I'm day trader, short-term liquidity will always lead to long-term general liquidity. Since my trades only last a couple hours or a day, they're very short-term. So I always prioritize the short-term general liquidity over the long-term general liquidity. The short-term liquidity will always lead to the long-term general liquidity. And when the body is over in the wick, and the body is big, thick candle, I'll enter the threshold. Only time I can bypass the threshold entry is when the market does an impulsive to the upside. In this case, market never did an impulsive to the upside, so we're supposed to enter the threshold. As well as when the wick is over in the body, I'll enter the resistance block, and that's that. That's the lesson. And I'll let you have proof of market tapping the threshold, market tapping the resistance block. So yeah, big lesson. We have fucking made the FOMO problem throughout the whole week, and yeah, we're on Thursday. We didn't have that problem, but on other days we did have that problem. So now this is my lesson of the Wednesday. This is part 3 out of the 5. Very beautiful lesson. Yeah, as you can see, this week we got cooked. We had literally no winning trade this week. We took a loss on Monday. Tuesday was a break even. We're supposed to be a 30-yard trade. Wednesday is not supposed to be a trading day. Thursday is supposed to be a 2.5-hour trade, which we literally fucking couldn't take a trade out of it. But we literally semi-missed it, semi-market recap, because that's a new scenario that I had, which I journaled down as well as on the on Friday we were supposed to be a trade, and it was supposed to end the trade with a fucking 32-hour gain, but we ended the trade with a fucking big loss. In this trade, I was around 2%, which is a normal size for an eval stage. Evals are always risking 2%, which I accept the risk. It's all accepted. I accept the risk and blow that account, which I'm very happy about, right? Accept the risk is all good. And yeah, because I'm trying to be more aggressive here, and I will only risk 2% from out here forward on the eval stages. So yeah, I'm very happy on this. So yeah, that's a lesson. And yeah, because me risking 2%, like when I do my trades, I don't count it on a percentage based. I count it more on the RR based, right? Because I could be risking 2% on a 4 RR, right? I'm not gonna say, okay, I made 8%. I'm gonna say I make 4 RR here. I'm not gonna say I made a loss, or I made 8 RR here, 8 RR here. I'm just gonna say I made 4 RR. Because if I say, okay, I lost a trade, I'm not gonna say I lose like 2% gain. I just lost negative 1 RR, right? That's all I'm gonna say. But yeah, if you're watching, make sure you guys like, comment, share, join the Discord, listen down below, and I'll see you guys later. Peace out.